Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer of Financial Enhancement Group. Thank you so much for giving us a few minutes of your time. Well, we're going to cover some of the things we talked about in this week's investment meeting, a very highly technically detail-oriented meeting, as they often are when we get into points of markets where they're at crossroads or we see more volatility. Clearly, we're drilling down to look more underneath the hood to see what's going on. Here's a menu item of the things we'll hit today. We're going to talk about bonds. Can't leave those out. We're going to look at 52-week lows, the trend of the S&P 500, and then share repurchases. So starting with those bonds, so we're looking at riskier bonds here. So pretty simple chart. What we're looking at is the extra rate of interest that is being charged to riskier bonds. So you have treasury bonds, those that are not at risk of default, and you have riskier bonds, those that are relatively high probability of going through some sort of a default. So naturally, they are charged a higher interest rate, or at least the market assesses them a higher yield on their bonds. And when the market begins to price as such higher rates of interest, that's when we get a little bit more concerned with investors getting to back off their risk taking. What we've seen over the most part going all the way back to early March, when the Federal Reserve became very aggressive, they actually even went to the step of buying corporate bonds. Very, very aggressive, and it worked. It drove the extra borrowing cost for companies down, and took some of the panic out of the market. Since then, we have seen nothing but calm and quiet in those markets. So we look at a couple of things in this environment. The first is we compare how have we done to other recent pullbacks. So we're now to about 3% in the major indices. So really minor in the terms of pullback and correction territory. However, this is where we really want to see, is it something different or is it not? And this is one of those markets we look to evaluate that. Back in September was the last time we had, early fall that is, a serious 3% pullback, or at least an initial one of those. And this market didn't react at all. This time, however, we're beginning to see a little bit of movement up, now 3.7%. In the scheme of things, in a bigger picture, that does not mean a whole lot. That is still relatively low. That is not a whole lot of extra interest for companies that have a high probability of default. However, it is a beginning of change, and it is different from what we saw in September. And it's also, one last thing, it's not unnatural towards the end of the year for funding to get a little bit tighter and for these spreads to move up. So that's something we will be watching. Andrew Thrasher and myself will be watching each and every day to see if this continues or not. So very kind of boring chart, but it tells us a whole lot of what's going on in the world of finance. Moving now to the S&P 500, one of those other facts as to whether or not this is a more serious correction or if it's just a minor movement is this chart right here. On the top is the S&P 500. On the bottom is the number of companies that have hit their 52-week low. When we see 10% drawdowns, those are circled on the chart below, in the panel below. And you can see we usually have a lot more of the S&P 500, a lot more of those companies hitting 52-week lows. So we've been highlighting in the weeks up to this, there have been some weakness under the hood and some crashes in a lot of individual stocks. However, in comparing to prior 10% pullbacks, we have not seen catastrophic damage or the level that we'd seen in prior instances. So it could work its way there. But as of right now, there is still a decent chance we have just seen a really mild pullback. Of course, things change and we'll be monitoring it. But as for now, that could very well be the case based on this. We've looked very much into this chart. This is something Andrew Thrasher, it is a staple of our investment allocation meeting, which I'll just take a second to say each and every one of you are invited to attend. It's not a very heavily attended meeting. It is quite boring. You can see some of the evidence right before you, things that I'm hitting, but you're certainly welcome to see what we talk about and what we're looking at on your behalf. This is a staple, something that you will see when we do meet. It is the trend, the daily trend of the S&P 500. The focus for us right now is that blue line on the S&P 500. It goes back into the later part of summer there in August, where the prior peak was at that point in time. What we've seen in the market so far is the S&P 500 retreat pull back in price. You look at the prices here in late November and December, we have retreated to that level. That is key for technicians like Andrew Thrasher, who puts this together. If we hold above that blue line, this could be a really healthy thing for the S&P 500 and the rest of the stock market. We don't know that it will hold, but we do watch that. It is absolutely not predictive of whether or not we will or won't break through that blue line. If we do, it tells us a whole lot that we've gained a new level of weakness, and then below that would be the next blue line, which would be the lows during that period. All right, so the prior highs is the first line that we're looking at as technicians, and then we're going to look at the prior lows, could be the next round of what would be support for prices. So there is a gap, and there is a reason there why we would need to be a little bit more defensive and come off of our offensive stance a little bit more than we have. Or last, a little bit of a longer term picture, but we're going to look at the timing of the S&P 500 companies and how they have been with regards to their share repurchases. Stock buybacks, of course, are now a politically charged topic, and this has nothing to do with that. It is simply look at how they have performed over time. The green line is the S&P 500, going all the way back to late 1998. Of course, we went through that period from the late 90s all the way into the late 2000s, where the market went nowhere. Two major crashes made sure of that happening. Meanwhile, stock buybacks are kind of all over the board. So the first point to notice is that they were really high at that prior peak. 2007 was one of those periods that were extremely heavy. Companies were buying back lots and lots of their stock. Turns out that was not a good choice because what happened there was the stock market, of course, crashed, and they would have had a much better opportunity to buy back at a later date. And they would have much rather had the cash on hand than they would. Of course, timing is 2020 with hindsight. But it does give you insight. And then to make matters worse, when the market did crash, then they didn't have the firepower to buy back their stocks when they were cheap. And we're starting to see some of the same things today. We saw that in late 2018, and now we're beginning to see that now where we're back to those high levels in 2018. Both of those were levels where the S&P 500 was at pretty rich valuations, was at a pretty steep price tag. When the market did correct last March, then again, the S&P 500 companies couldn't be aggressive in buying back their stock, and they're getting back there today. That doesn't mean that the S&P 500 is going to have another correction or pullback, but history does say that those companies are not good with their stock buybacks. Another thing we want to glean from this is that not all companies are created equal. This isn't that every company in the S&P 500, this is an aggregation. There are plenty who are great stewards of their capital. In fact, plenty of them who are savvy enough to have issued stock when the valuation, when the prices are high. That can be a painful thing to do at the time, but over a long period of time, that can be quite healthy. Then if the company in turns buys back their stock when the market is cheap. So as we look at companies, that's one thing we look for, how good and how much care they give the stewardship of the equity capital on behalf of our shareholders, you. So again, thank you for giving us a few minutes of your time. Hope everyone has a great weekend. You have a chance to schedule your complimentary meeting. Please give us a call, 800-928-4001. Especially these markets are beginning to be choppier. Volatility is higher. It had been low and sanguine for quite some time. Our expectation would be that it is higher, not that we have any sort of instinct or premonition, but simply that's what happens when the Fed begins to withdraw support, and that's all but certain at this point in time to happen, absent any major developments. So if we can be of any help to help you navigate that, please give us a call or scan the QR code. We'd be happy to give you a complimentary meeting. And of course, don't forget a chance to listen to the radio show where we'll provide weekly insights either through the traditional airwaves or however you get it through your podcasts medium. So once again, thank you. Have a great weekend.